Today, we're going to walk a financial tightrope. We're diving deep into the hidden risks inside the global banking system. I mean, it's a system that affects every single one of us. But how does it really work? And more importantly, where are its weakest links? It sounds a little crazy, doesn't it? How can a handful of missed mortgage payments, in just one country, create a shockwave that topples financial giants thousands of miles away? Well, the answer is a kind of hidden chain reaction. And that chain reaction, it doesn't just start with some random bad loan. No, it starts with the most fundamental part of any bank, its balance sheet. So let's get right down to it. A bank is in this constant, really delicate balancing act between what it owns and what it owes. And its entire survival depends on keeping that scale from tipping over. It all boils down to a super simple equation. You've got assets, things like loans the bank has made, and those have to balance with liabilities, which are things like your deposits. The difference between them, that's the bank's equity. You got to think of it as the bank's own money, its safety cushion, the shock absorber that takes the very first hit when things go wrong. All right, take a look at this. This is a healthy bank. It's got $50 billion in assets, balanced by $45 billion in liabilities, which leaves a pretty solid $5 billion in equity. That's a 10% cushion. Seems pretty safe, right? It can handle a few bumps in the road. But now, watch what happens when a crisis hits. A loss of just 6 billion euros on its loans, that's a little more than 10% of its total assets, it doesn't just shrink the bank, it completely wipes out that 5 billion euro equity cushion. And then some. The bank is now insolvent. Its liabilities are bigger than its assets. This right here is the scary power of leverage, and it's why a seemingly small drop can be absolutely catastrophic. So, because of this built-in fragility, regulators can't just cross their fingers and hope for the best. No, they try to build a safety net with a whole bunch of rules designed to prevent this exact thing from happening. So, why all these rules? Well, it's actually pretty simple. When a bank fails, the damage doesn't stop with its owners. It spills out into the entire economy. Economists have a term for this: negative externalities. Basically, the social cost, the cost to all of us, is way bigger than the bank's private cost. That's why financial stability is treated like a public good, something that needs to be protected by global standards like the ones set by the Basel Committee. To make this happen, regulators force banks to hold specific kinds of capital. You've got Tier 1 capital. That's the really high-quality stuff, the going concern capital that helps a bank absorb losses and just stay in business. Then you have Tier 2. That's the gone concern capital. It's only there to pay back depositors and other creditors after the bank has already gone under. You can think of it like this. Tier 1 is a fire extinguisher in the building, and Tier 2 is the fire insurance you collect after it's burned down. But what if you could just engineer the risk away? For a while, the financial industry really believed it had found a kind of magical solution, a process that could make banking safer for everybody, and it was called securitization. People seriously looked at securitization as a form of financial alchemy. The promise was incredible. You could take risky, individual things like mortgages and magically transform them into safe, tradable investments that people all over the world would want to buy. So here's how this magic trick worked. First, a bank scoops up thousands of similar loans, like mortgages, into one big pool. Then it sells that whole bundle to a separate company. That company then chops up the bundle of loan payments into brand new securities, kind of like bonds, and sells those to investors. But here's the crucial final step: slicing these new securities into different risk levels, or what they call tranches. And this is where the magic really happens. Out of one 100 million euro pool of regular mortgages, you create totally different products. The senior tranche, that's the biggest slice, is the safest. It gets paid first from all the incoming mortgage payments. The mezzanine tranche gets paid second. And that little equity tranche at the bottom, it gets paid last, but it also absorbs the very first losses. So the thinking was, if a few homeowners default, only the risking equity investors lose money. The senior tranche, it seems incredibly safe. But, and this is a huge but, this entire beautiful, complex structure was built on one single, critical, and ultimately deeply flawed assumption: diversification. The belief that, sure, a few loans might fail, but they would never, ever all fail together. And this is where the hidden danger was lurking. Look, if two loans each have a 10% chance of going bad, but they're completely independent, the odds of both of them failing at the same time is tiny, just 1%. That senior tranche is super safe. But what if the loans are connected? What if they're all tied to the same housing market? Now, if one fails, the chance of the other one failing skyrockets. The probability of both of them defaulting jumps from 1% all the way to 8%. All of a sudden, that super safe senior security isn't safe at all. That's the power of correlation. And that hidden danger, that power of correlation, well, that's exactly what happened in the years leading up to 2008. The financial magic that was supposed to get rid of risk ended up just concentrating it and hiding it in plain sight. Here was the fatal flaw. Banks weren't just bundling up normal, safe mortgages. No, they were pooling billions and billions of dollars in high-risk, subprime loans. And nearly all of them were tied to one single thing: the U.S. housing market. The risk wasn't diversified at all. It was perfectly, dangerously correlated. And then came the trigger. After climbing for years, the U.S. housing market peaked around 2006 and then started to fall off a cliff. As house prices tanked, those subprime borrowers couldn't afford their payments, they couldn't refinance, and they started to default, not one by one, but all at once. The dominoes began to fall hard. On September 15, 2008, Lehman Brothers, an institution that had been around for 158 years, completely collapsed under the weight of these toxic mortgage securities. It was the biggest bankruptcy in U.S. history, and it sent a terrifying signal to the world. The crisis was real. The result was just pure panic. The VIX index, which is basically the market's fear gauge, shot up to levels nobody had ever seen before. No one knew which banks were safe anymore, credit markets froze solid, and the entire global financial system just shuddered to a halt. And the crisis didn't even stop with the banks. In Europe, it set off something they call the sovereign bank doom loop. See, governments had to spend billions bailing out their failing banks, which made the governments themselves look financially weak. And that, in turn, scared investors and made the banks even weaker because they were holding tons of that same government's debt. It was a vicious, self-reinforcing cycle. So, in the aftermath of all that chaos, regulators realized the old rules just weren't good enough. They needed a totally new approach for dealing with failing banks. The old system was the bailout. Translation: taxpayers foot the bill to rescue the banks. Politically, that was a disaster. The new philosophy is the bail-in. Now, when a bank gets into trouble, its own shareholders and some of its creditors are the first in line to take the loss. Their investment is forcibly converted into new equity to prop up the bank and protect taxpayers. So, where does all this leave us today? Well, we've definitely built a system with stronger capital rules and new ways to handle failure. But the world of finance never, ever stands still. So the real question is, have we truly tamed the risks of walking that financial tightrope? Or have we just created a more complex system with new weaknesses that we haven't even discovered yet?